Welcome to Talk Tickers. We're here to synthesize the latest corporate calls, specifically for you, the discerning investor.
And today we're doing a deep dive into Embraer SA. They just changed their ticker, actually, to EMBJ. We're looking at their Q3 2025 earnings call.
Right. And our mission today is really to cut through some of that market noise. We saw some volatility after the print.
Yeah, definitely. The market seemed spooked by the margins initially. But the question is, does that short-term pressure outweigh this, massive long-term growth story they have, which is anchored by that record backlog?
Exactly. Are we looking at near-term bumps or, multi-year visibility? Let's start with the snapshot, because fundamentally, this was a pretty clean beat.
It really was. Adjusted basic EPS came in at $0.64. That smashed the FactSet consensus, which was around, 46 cents?
Yeah, significantly better. And a top line, a record third quarter.
Revenue hit $2.004 billion.
Again, beating consensus there, which was about $1.93 billion. And that's an 18% increase compared to last year. Solid growth, undeniable growth. But, okay, let's get to the number that caused the jitters. The margin. Adjusted EBIT margin landed at 8.6%.
Right. And if you just look at the number from last year, 3Q24, which was 17.6%, 8.6% looks like a huge drop, a really big fall.
Mm-hmm. But this is where that context is just so critical, isn't it? You have to remember that 2024 number, it was massively inflated.
Massively. By that one-time payment from the terminated Boeing agreement, basically a breakup fee.
Exactly. So if you strip that out, that extraordinary item, the comparable margin last year was actually closer to 8.7%.
So going from 8.7% X item down to 8.6% this quarter. Well, that's hardly a compression at all. It's almost flat.
Right. It was the visual, the headline number that seemed to trigger that initial dip in the stock price, kind of a knee-jerk reaction.
Totally. But then you saw that swift recovery the next day, which suggests investors quickly looked past the headline and saw the quality of that 18% revenue growth underneath. The story held up.
And I think what really shores up that confidence isn't just the quarterly numbers, but the financial foundation they're building. It looks really solid.
Oh, absolutely. Look at the adjusted free cash flow, excluding Eve, their EV title of venture. It was huge in Q3 alone, $300.3 million generated.
That kind of cash generation, it just changes the narrative, doesn't it? It means they're not scrambling, they're building stability.
Precisely. And you see it on the balance sheet. The net debt ratio plummeted. It's down to just 0.5 times, again, excluding Eve. That shows some serious liability management. Real progress on fixing the balance sheet.
And the credit markets are noticing. S&P upgraded them, BBB rating now.
That's a big deal. Investment grade. It gives them so much more flexibility.
Which leads directly into what they did with their debt, that proactive liability management. It sounds technical, but it's important.
Yeah, what they did was issue $1 billion in new long-dated bonds, 12 years out at a pretty decent 5.4% coupon.
And then they used that cash to buy back some of their older bonds, the ones due in 2028 and 2030.
Right. So they're extending their debt duration, locking in rates, basically insulating themselves a bit from future interest rate hikes. It's a smart move, capitalizing on that new BBB rating. Strategic.
Okay, so the finances look strong, stable. But what about operations? This is where I thought the CEO made a really significant statement. It kind of shifts the whole risk picture for 2025, maybe even 2026.
You mean the comment about the supply chain?
Exactly. Management stated quite definitively that the risk for the supply chain in 2025 is over. They said they've secured all the parts needed to execute on the backlog.
That's a massive statement for any aerospace company right now. If true, it means a huge external risk is basically off the table.
It is a huge statement. But I guess the question is the risk truly over or just secured for, the currently planned 2025 deliveries? Does it just shift the pressure onto their own internal execution, making sure the factories can keep up?
Well, yes, it absolutely does shift the focus to internal execution. But that's a good thing from a risk perspective. Managing internal processes is frankly much more controllable than managing global supply chain chaos.
Fair point. It puts the ball firmly in their court.
And that confidence clearly allowed them to reiterate their full year 2025 guidance. They're sticking with revenue of $7.0 to $7.5 billion.
Adjusted EBIT margin between 7.5% and 8.3%, and free cash flow of at least $200 million.
And interestingly, while they kept the guidance range, Management did signal pretty strong confidence. They suggested they could potentially hit or even exceed the high end of that margin range.
If, and it's a big if.
Yeah.
They nail the really intensive delivery schedule they've got planned for Q4.
Right. It all comes down to throughput now. Can they build and deliver the planes efficiently?
Okay, let's pause for a second and just quantify that margin headwind we talked about earlier, the thing that maybe caused the initial anxiety.
Yeah, the U.S. import tariffs. They were very specific about the impact.
It was a $17 million headwind in Q3 alone, which translates to, what, about 85 basis points of margin compression just from that?
Exactly. A specific, quantifiable impact. And importantly, they're not just sitting there taking the hit.
No, they said they're working actively to reduce the full year impact. It was initially expected to be maybe $65 million.
And they're tackling it through things like localization, sourcing more parts domestically, and also adjusting pricing. They're trying to manage it internally.
Okay, so balance sheet getting stronger, supply chain risk apparently managed, the margin drag is quantifiable and being addressed. What's the real anchor then for, the positive long-term view?
It'd have to be the demand, that visibility.
Absolutely. The foundation is that record firm backlog, $31.3 billion. That's up 38% year over year. It's enormous.
Enormous. And don't forget the options. There's potentially another $20 billion in unexercised purchase options sitting behind that firm backlog.
So total potential visibility is pushing towards, what, $50 billion? I mean, that's years of production locked in, not quarters, years.
Incredible visibility. Now, if we look at how the segments performed in Q3, commercial aviation really stood out.
Yeah, revenue there was up 31% year over year, strong growth.
And crucially, the margin improved significantly. Adjusted EBIT margin turned positive 1.3%, up from negative 4.8% last year. That shows the EJet program is finally getting some real operating leverage.
Definitely. Executive aviation, though, was a bit more mixed. Revenue growth was modest, about 4%.
Right, and this is where those tariffs really bit hard. Margins decreased 4.2 percentage points overall.
And they specifically called out that 2.6 percentage points of that drop was directly due to the U.S. import tariffs hitting the business jets.
Mm-hmm. On a brighter note there, though, they did deliver their 2000th business jet, which is just, a pretty cool milestone.
Yeah, definitely a landmark. Defense and security looked strong.
Very strong. Revenue up 27%. And the margin jumped substantially to 12.9% from 7.2% last year.
Driven by higher volumes of the KC-390 transport aircraft and some kind of one-off positive contract adjustment. Something about reassigning a plane during production.
Yeah, bit of a tailwind there. And finally, services and support. Always that steady pillar.
Revenue up 16%. Solid. Margins did dip here, though, down about 5 percentage points.
But they put that down to temporary delays in getting materials and services. Management seemed confident that would bounce back to normal levels, around 15% in Q4, so sounds transitory.
Okay, so connecting this huge backlog and current performance to the future, the CEO seems to be thinking way beyond the current 5-year plan.
Definitely. They're talking about investing in new tech, electric, hybrid propulsion, future stuff.
And what I found particularly interesting was the hint about maybe developing new commercial jets. Could be larger, could be smaller than the current E2 family.
Right. That opens up a whole new avenue for future R&D and market positioning. It's ambitious.
And we can't forget Eve, the eVTOL project. That's still progressing. They're planning the first full-scale prototype flight for late 2025 or early 2026.
So yeah, this isn't a company just sitting back. They're executing now, but also clearly planning for the next couple of decades.
Okay, so if execution is the main story now, and the balance sheet risk is largely gone, the big question for you, the listener, is how does the market start pricing in this, pretty unparalleled visibility?
Which brings us nicely to our This Is Not Financial Advice segment.
Right. We saw that initial price volatility. Implied vol was extremely high around the earnings print.
So the trade idea revolves around monetizing the idea that, look, the Q3 margin dip was temporary, it was quantifiable, and crucially, that supply chain risk is now claimed to be over.
The setup seems clear. The narrative is shifting. It's not a supply-constrained redund anymore. It's about scaled execution against a massive backlog.
Exactly. And with that strong free cash flow and the new BBB rating, the market arguably should stop focusing so much on the short-term margin blips and start fully valuing that multi-year visibility and the improving operational discipline.
And don't forget the kicker, capital allocation. Management explicitly put share buybacks on the table. That's a potential game changer for the equity story.
Huge potential catalyst.
Yeah.
So the trade idea is basically a bet on that execution story and the capital return narrative taking hold.
How would you structure it?
Well, One idea could be to buy some midterm call options, maybe 6 months out, looking towards 2026 execution.
Okay.
And you could potentially fund that premium, or part of it, by selling some near-term out-of-the-money puts or calls, basically structuring it to benefit if volatility comes down as the market gets more comfortable with the execution story.
So you're betting on volatility compression and a re-rating based on them delivering in 2026.
Essentially, yes. Betting that operational discipline wins out over the near-term noise. Again, this is absolutely not financial advice, just an idea based on the dynamics.
Understood. So let's recap the main takeaways. The constructive view seems pretty solid here. You've got exceptional cash generation, incredible demand visibility.
Right. And those factors really seem to successfully offset the, frankly, expected margin pressures from tariffs and mix in Q3. The foundation looks set for them to just focus on executing on scaling up production.
The narrative has shifted, hasn't it? From balance sheet repair and managing supply risk
To optimizing throughput, hitting delivery targets, and figuring out how to deploy the cash they're generating.
And that really leads us to our final thought for you to mull over. With the balance sheet looking so much healthier, that net debt down to just 0.5 times, the entire focus shifts to capital allocation.
Exactly. The big question now isn't can they survive, it's what will they do with the excess capital? Will it be aggressive share buybacks? Will they start thinking about higher dividends?
That question is now firmly on the table, as they said. And for a company like Embraer, moving from fixing the balance sheet to actively deciding how to return cash to shareholders, well, that's maybe the most fundamental shift in the investment thesis going forward. Something to think about.